Welcome everyone to Wealth Office Hours Live with Matt Sorensen. I'm excited to be with you today. We are talking about making sure you get every tax strategy available to you before you file your business tax return. Now today we're talking about tax strategies for business owners. And specifically what we want to be thinking about is before the return gets filed. The tax return deadline for most S-corp or partnership owners is March 15th. You got some extensions, we'll talk about that. But once you file, your options for tax planning shrinks dramatically. The biggest tax savings don't come from filling out the forms correctly. They come from making strategic decisions before the return is even finalized. So I want to make sure you're aware of what you should be doing on your return. Now, there's been some important updates and renewed strategies under recent tax legislation. We've all heard about the One Big Beautiful Bill. But this law creates some additional planning opportunities, things like 100% bonus depreciation that's back, the state income tax deduction workaround for pass-through entities. It's a mouthful, but it'll save you tens of thousands of dollars if this strategy applies to you. We're also going to hit retirement plan contribution strategies and also some entity elections and a lot of common strategies people just miss on their return year after year. And what we're going to go over is not any fringe strategies. These are core planning tools that, if implemented correctly, can mean tens of thousands of dollars in tax savings. My goal here is to keep more of your hard-earned money in your pocket and not the IRS's. But here's the reality. Most business owners are reactive with taxes. They meet with their CPA or accountant if they have one, or maybe they're hacking this out, not knowing what the hell they're doing on TurboTax. But this is happening in March or April when they drop off the documents and they're just hoping all for the best. Well, that's called tax compliance. You're basically doing what the IRS wants you to do. What we're talking about today is proactive strategy. We're looking at deductions that you might not be maximizing and some structural decisions and things you can put in place that will keep more money in your pocket. All right, so the goal here is we want to shift income and expenses in your favor. We're going to talk about areas that are misunderstood, bonus depreciation, the QBI, the right way to handle auto, home office, how to think about travel. I'm going to go into also retirement accounts and things you can still be doing. Even if you didn't do it back in 2025, you can still do some things now that'll save on your 2025 tax return. Now, sometimes the best tax strategy is simply moving money around in a vehicle that compounds, whether it's tax deferred or tax free, and this is where retirement accounts come in. The goal of today's episode is simple. Before you sign your return, make sure you've pulled every lever available to you, whether you're a solo entrepreneur, you're an S-corp owner, you're a real estate investor, you got a main hustle, side hustle, you're growing and operating a business. There are strategic decisions you can still make that materially will change the outcome on your return. Now, after we go through these strategies, I'm going to go over Q&A, ask your questions in the chat. My team's in there as well. I've got a lot of questions that came in on advance on this for a lot of these topics that I think are really, really good. The nice thing here is a lot of the people that have been on Wealth Office Hours Live, or maybe you've been in my YouTube videos, we're getting some awesome questions that I know many of you are thinking about. So we're going to be hitting those. I probably got 20 questions on point to the topics we're going to talk about today. All right, so let's first dig into what are the new tax strategies or some of the stuff that was renewed in the One Big Beautiful Bill. Now, under the One Big Beautiful Bill, this is the big tax legislation President Trump championed. Really, Republicans in Congress, they all came together. It was partisan, but whatever. It passed. It's in law. It's going to save you money. All right, now the first one here you probably heard about is something called bonus depreciation. But what the heck does this mean to me when I'm filing my tax return right now? Now, I'm assuming you're a business owner. Bonus depreciation is essentially a way that you get to accelerate writing off an expense. So for example, let's say that you're a contractor and you bought tools in your business, then it cost you $100,000 for all this tools or this equipment. Well, you generally write that off over 5 years. What that means is I take a $20,000 expense every 5 years, 1 year at a time, to get to the total $100,000 write-off. Well, that's not very great. That sucks because I don't get the value of that deduction immediately. I have to, even though I might have spent the money, and by the way, you could have got a loan to buy it, doesn't matter, as long as you acquired that asset in your business, the tools here in the example. But that sucks if I spent the money to go put this out because it was money out of my business, but I don't get the write-off on it yet. Well, under bonus depreciation, you do. So what can happen is you can decide to take bonus depreciation on the equipment in the example here, tools, let's say if you're a contractor, and now I get to take the $100,000 deduction all in year one. That is massive. What I'm doing there, and what happens because of this bill is instead of taking $20,000, I get to take a $100,000 deduction. All right. That's called bonus depreciation. This is equipment, tools. This could be vehicles in your business, maybe trucks or delivery vehicles, whatever it might be. These are all things you can take additional bonus depreciation. And by the way, bonus depreciation is back, baby. This applies in 2025. There are some of the things in the One Big Beautiful Bill that didn't take effect till 2026, but the things I'm going to be talking about today all are effective for tax year 2025. So if you bought equipment, don't take it over the 5-year or 7-year, whatever the life is. If you want a bigger deduction, let's get it all now and take the bonus depreciation. Okay, the next one you've probably heard about is QBI, or maybe the 20% small business deduction. All right, now QBI, where there was a provision, it was going to go up to 23%, but in the final bill that actually passed, it stayed at 20%. Now, the reason this was big is this was set to go away. This was a tax incentive for small business that was going to go away in 2025, but it was renewed and brought back to life in the bill. Now, what this deduction does is this gives you a 20% deduction on your business income. Let's say you have a business that makes 200 grand. Well, if you are a small business owner, frankly, a big business owner, pretty much anyone who's an S-corp, an LLC, partnership, sole proprietor, you have to be a pass-through type entity, you get to take this 20% deduction. What happens is that 20% deduction, in the example of 200K, will be a deduction of 40 grand. So now I'm only taxed as if I made $160,000. Or another way to say it is I got $40,000 of tax-free income because of this QBI deduction. Now, obviously, if you made $1 million, we'd be getting a $200,000 deduction. This is powerful. Now, if you're a C-corp owner, the big corporations, their deal was years ago, corporate tax rate went from 35% to 21%. That's still the case. If you're a C-corp owner, you don't get to take this. You've got the reduced corporate tax rate down to 21%. All right, so that's QBI. Now, I've got some questions on QBI we're going to be hitting later, but that's the QBI qualified business income. Next one, state income tax deduction. This is a big one for 2025. Now, this is whether you're a business owner or individual, frankly, but a lot of business owners that are higher income in particular aren't able to take the state income tax deduction. So under prior law, and what was set to be in effect for 2025 was you can only take a deduction of $10,000 for your state income tax. So let's say, for example, you live in the state of California, you make 500 grand, and you send the state of California 60 grand in state income tax. Well, when you make 500 grand, you would want to say, that would mean I'd only have to pay federal income tax on 440,000, right? Because the state took 60,000 right off the top. So the federal government can't tax me on money I had to send to some other tax jurisdiction, right? So why, that makes sense, right? Well, no. The federal government's like, no, we're still going to tax you on that money you paid your state. We only let you take a deduction of $10,000. Now, the One Big Beautiful Bill increased that deduction to 40 grand. Okay. So now in that example, let's go back. In California, made 500K, paid 60K to the state of California. Well, you actually get to take a $40,000 deduction to the federal government that reduces your federal taxable income from 500 now to 460. Okay. This is called SALT, state and local tax. Now, this is the deduction on your federal tax return that you're getting credit because you had to pay a state or local government. All right. Now, let's say you're in a state that has no state income tax and you don't own property where you're paying property tax. This doesn't matter to you. But for those of you in a high income tax state where you're paying property tax or income tax, whatever state and local tax is, we want to be able to deduct that against our federal taxable income on our tax return we send to the IRS. Now, the question becomes here, and sorry for the setup, but the question becomes, well, What if my state and local income tax is more than 40K? In the example I gave you, it's 60,000. So I only got to take a $40,000 deduction. I made 500. State and local tax deduction lets me take a maximum of 40. So I really only am taxed if I made 460. Yes. By the way, there's high income phase outs on this too and everything. So the limitation on this is not great if you're a high income earner. So there is a workaround. This is called the SALT pass-through entity workaround. I know it's a mouthful, but it matters. If you're an S-corp owner, you have an LLC, partnership, sole proprietorship, you're making more than $500,000 a year, and you're paying more than 40 grand in state and local income tax, you need to know about this new rule and this new strategy. What you do is you pay the state and local tax out of your business entity. Let's say you're an S-corp owner. Now let's go back to that example, making 500K. You're not paying your state and local tax personally. Your company is going to pay it on your behalf. They effectively take the deduction, and they're not limited by the 40,000 amount. You get a credit for it as an individual when you file your return. Now that's the gist of it. We've got more content on this, articles and other podcasts and videos I've shot on SALT. And you want to work with your tax advisor or tax lawyer on this to get more details on it. But I just am trying to flag this right now for planning purposes. And it might be too late right now. If you're trying to do this for 2025, it's actually too late. You would have had to have paid this in from your entity back in 2025. But know this for 2026. When you're making your estimated payments to your state, maybe start thinking about paying them through your business entity where you will not have a cap on the total deduction amount. All right, little high income strategy there, but pretty cool. It's an unlock for any of you business owners. All right, tips. What if you're a tipped worker? Maybe you're someone that's self-employed. You're a hairstylist. You do nails. You drive Uber or DoorDash, or you do bartending on the weekends. You're in the gig economy. You're playing at bars. I don't care what it is. You're a musician. You're getting tipped income. Well, there's no tax on overtime and tips. And for any of you that are self-employed, getting tipped income, you can take advantage of this deduction as well. So there is a deduction of up to $25,000 on tipped income. What that means is you can be paid up to $25,000 a year in tipped income and not be taxed on it. All right. Now, if you're a self-employed person, the way you're going to do this is on Schedule 1A on your 1040. All right. If you're a W-2 worker who's tipped, this actually should be on your W-2. But for self-employed people, any of you, whether it's a side hustle, main hustle, doesn't matter. You get tipped income as part of the money that you're making. Make sure you're taking this deduction. It's up to a maximum of $25,000. Now, if you're high income, though, all right. So let's say you're, I don't know. I was going to say Taylor Swift. Okay. I don't know. I have 11-year-old stepdaughters. So what can I say? Not there's anything wrong with liking Taylor Swift. Okay. Don't get me wrong here. Okay. All right. Let's say that she got a $25,000 of tips for, singing at some concert or some event or something. I don't know. Okay. Well, she can't take advantage of this because there is a high income phase out. If you make more than $150,000 a year single or $300,000 a year married, this deduction for tipped income phases out and you don't get to take it. But let's say that you're Taylor Rift playing at the honky tonk bar on weekends, and you're making $50K a year. You get a deduction of up to $25K. All right. Do you like what I did there? Yeah. Is that all right? Taylor Rift. I don't know. I mean, it's just so I'm working with. I'm doing the best I can here, guys. All right. I'm obviously making this up as I go sometimes. So, but this is a cool one. I think a lot of people misunderstood this no tax on tips, didn't think it was going to work for self-employed people, but it works for self-employed people as well. Okay. Those are 4 new ones that were part of the One Big Beautiful Bill. No tax on tips. We got the SALT workaround. We've got the the bonus depreciation, and we've got QBI. Okay. Those are 4 ones. renewed or brought back to life are entirely new from the one big beautiful bill that are effective on your 2025 return. So make sure you know about them and take advantage of them if they apply in your situation. Now, the next thing I want to go over is 7 more strategies. These are the most common 7 strategies that are overlooked and not taken on business owner tax returns. So I want to make sure you're familiar with the other strategies that you can take on your tax return that's going to reduce your taxable income and keep more money in your pocket. All right, let's start with the first one, home office. This is one you're not even putting money out of your pocket for. Okay. Obviously, if you have an actual office or a place of business, you're writing off the rent or the cost of that building or facility. But maybe you're working from home and you have a home office. Well, you can take the home office deduction. Okay. We take the portion of the home, let's say 10% of the home is what you're using for your home office or to do work from your home. This doesn't have to be an office. This could be your garage that's full of all of your inventory in your business. This, I don't care what this is, but it's a place in your home that is used exclusively for business. It's permanent. All right. We get to take that as an expense. So we're going to add up all the expenses for that. Maybe you're renting your home. So we take, let's say it's 10% of the home is dedicated for this office. Your rent's, $3,000 a month. We're going to take $300 as a monthly deduction for this, but we're also going to write off utilities, internet, other things that are the expenses for this property, maintenance on the property. If you own it or rent it, either way, all the expenses that go up to maintain the property, we're going to add up, and you can take an actual write-off based on the percentage of the home that you're using exclusively for business. Now, that is one way to take home office. There is also a simple method that says, don't track all those expenses of what you're paying for your home and the percentage of you use for the business. Instead, you can call it to what's called the simple method, which is a maximum write-off of $1,500. And basically it's like $5 a foot up to 300 square feet there. That gives you the $1,500 a year. And the IRS is like, just claim that. That's the easy way if you're in that boat. The nice thing about that is you're not tracking all these expenses and having to do all the hard work. But if your costs of this and the home in the area you're using for your office or work or place of business at your home is significant, let's take the bigger write-off and let's actually do the work and track it. Okay, so that's home office. A lot of people forget that because it's not like in their QuickBooks. It's not on their spreadsheets. It's like stuff they're paying for personally, typically, so they'll forget to take this expense. And don't be afraid of taking the home office. We sometimes hear people, and I see this on TikTok or other social media, that's like the home office deduction's a red flag. No, it's not. And even if it is, if you're using it properly, you're entitled to it. All right, don't be afraid of taking these deductions. All right, next, auto. Okay, now in auto, this is like your vehicle that you're using for business purposes, all right? We can take a write-off for that. Now you have 2 options. You can take actual expense or you can do mileage. Actual expense, what you're going to do is you're going to say, all right, I use my auto 60% for business. So 60% of the expenses for that auto, I am going to write off. Let's make it easy. Let's say it was a lease payment of, I don't know, $1,000. Okay. Just so I can do the math here. $600 of that lease payment is going to be an expense. Also the gas, 60% of the gas, also 60% of the insurance, 60% of the maintenance. Okay. We're tracking all of the actual expenses here. And then we're taking the percentage of use of the car, personal versus business. And it could be 100% business, which makes it easier. And then we're taking that as a deduction on your tax return. Now, another option, though, is doing mileage. And actually, most clients that I've worked with over the years do mileage. Mileage where you just track your business miles and you get to take a 70 cents per mile deduction. For example, let's say you drove 10,000 miles during the year for business purposes. Let's say you're a real estate agent. You're driving to properties, you're showing homes, you're looking at properties, you've got mileage, right? You're out and about. Like dentists shouldn't have much mileage. Maybe they do. They're going to a conference or meeting some other people or whatever, but they're working typically in an office, right? They're drilling and billing at the office, okay? But the realtor, some other people, contractors, they're out working, right? They're out at a location or a job site. And so they're typically going to have more miles. So to again go back 10,000 miles at 70 cents a mile, that's the IRS rate for 2025. That means you get a $7,000 deduction. Okay. Now you got to track those miles. You have a record of this, whether this is your calendar or there's other apps for this. You can have a journal. I don't care. This is not filed on your return. You just want this in the case of an audit, though. All right. Now, the one thing I just want to note here is on actual versus mileage is if you're going to use bonus depreciation, what we talked about earlier, and let's say you bought a vehicle, let's say you bought a truck in your business, you're a contractor, you bought a truck in your business in 2025, and you're like, ooh, I want to take that bonus depreciation. That truck was 50 grand. I want to write the whole thing off in 2025. Okay. You're doing actual, okay? You're not doing mileage on that. When you do bonus depreciation, you're going to be taking actual mileage for the vehicle. You're going to be taking actual expenses for the vehicle. Okay, that mileage of 70 cents is meant to encapsulate everything: your depreciation, your gas, your insurance. It's kind of a grab bag to say, just track your miles and we'll give this to you. So you don't get to take bonus depreciation if you're doing miles. All right, next one. Want to make sure you're getting is just equipment in your business. A lot of people forget about this. This is the laptop you bought in your business. This is maybe tools in your business, equipment, office furniture. Like, be very cognizant of the things that you're using in your business. Some of these you might have some personal use of, but you actually bought it for the business. Let's make sure we're writing that off and taking that as an expense in the business. So take a step back and think, what are the new things I bought and we're using in my business in 2025? Let's make sure we're grabbing those and getting those on the tax return. All right, next one. See, this one missed a lot. Travel. All right. When you are traveling for business purposes, let's say you went to a conference, let's say you went to a training, you met with customers or vendors, any of that travel, airfare, hotel stay, parking at the airport, meals while you're traveling, that's all an expense. We're writing that off. All right. So make sure you're tracking that travel for business purposes. Okay. We're not talking about you had a personal trip and you met with someone for business and you're writing off the whole thing. Okay. Maybe that meeting or that meal with that person is deductible, but the whole travel doesn't automatically become unlocked. So we got to be reasonable there on what we're actually taking. Okay. Next one I want to hit is solo 401ks, SEP IRAs, IRAs. I want to go over the self-employed retirement plan options you still have right now that you can adopt new retirement accounts, make new contributions, and get 2025 tax deductions. Even though we're sitting here in 2026 right now, we are going to get a 2025 tax deduction that will mean we can send in less to the IRS. If we do traditional dollars, we can send in less to the IRS for 2025. Okay, so I want to go through the three options here. The first is just doing an IRA. Let's say you're like, Matt, I have an extra $5,000 I could put aside to invest, or maybe $3,000. Well, the first thing we're going to say is just do an IRA. Put it in, you can choose to do traditional or Roth. If you do a traditional IRA, you're getting a $5,000 tax deduction. So if I made $100,000 that year, and I put $5,000 into the traditional IRA sitting here in February, March of 2026, that reduces my taxable income on my 2025 return by $5,000. So now I'm not taxed if I made $100,000. I'm taxed as if I made $95,000. Okay. And that's nice. Another way to think about it is I got $5,000 of tax-free income there. And that money now is invested in a retirement account, growing in a tax-advantaged way. Now, if I did a Roth contribution, this is whether this is a Roth IRA or Roth SEP IRA or Roth solo 401k, you don't get a deduction on the Roth contributions, but that money is going to grow and come out tax-free. So it's still a great tax strategy because I'm maximizing these tax-free dollars that get to grow over time. But if I'm trying to save money today, you're going to be looking at traditional deductions. Now, you might say, well, Matt, I want to put 10K, 20K, 50K away for 2025 still, and I want to get a deduction for it. The IRA is not enough, or maybe I've already done the IRA. What else can I do? Well, you've got two other options. The first is a SEP IRA. Okay, a SEP IRA is an IRA if you're self-employed, you can establish for yourself. This is generally popular when you have no other employees. But in a SEP IRA, you can put 25% of what you made from your business into an IRA as a contribution. So if you made 100 grand, you can put up to $25,000 into the SEP IRA. You made 200 grand, you can put in 50 grand. All right. Now the SEP IRA maxes out for 2025 at a total contribution of 70 grand. Now, the SEP IRA works best again when you don't have employees, because if you have employees and you put in 25% of what you make, you have to put in 25% to your employees' SEP IRAs of what they made. So people don't use the SEP IRA when they have employees. This is best when you're self-employed, independent contractor, whatever. You have no other employees that would be eligible. Now, despite the SEP IRA giving me a much larger contribution, I don't like the SEP IRA. I think you should instead do something called the solo 401k. Now, we set up lots of solo 401ks. We do SEP IRAs at directed IRA too. We do IRAs, of course. You can invest in all types of alternative assets. That's what my company, Directed IRA, does every day. I mean, we'll set up 500 to 1,000 new accounts a month of clients setting up tax advantage retirement accounts, IRAs, solo 401ks, Roth IRAs, HSAs even. And they're doing these to get tax deductions now, if they're doing traditional dollars, or to build tax-free wealth where they're not taxed on the way out if they're using Roth dollars. But either way, it's a strategic tax decision to get money in retirement accounts, whether it's about saving taxes today or saving taxes in the future. Now, solo 401k. Why I like the solo 401k is I can put a lot more money into this on less income. You can put up to $70,000 a year into a solo 401k for 2025. But the way I put money in a solo K is easier than a SEP IRA. I can max it out and get more money in the solo K than I can a SEP IRA at a faster rate. So for example, let's say you made 100 grand a year. And by the way, the 100 grand a year there, if you're an S-corp owner, whether it's a SEP IRA or a solo K, we're looking at your W-2. So like when I say 100K, this is not your total business income. This is what was on your W-2. That's what drives retirement account contributions like a SEP IRA or a solo K. So let's go back to that example. Let's say you had 100,000 on your W-2 from your S corporation. Well, in a SEP IRA, you can put in 25%, 25 grand. In a solo K, I can put in 25% as the employer. But since this is a 401k, you get to put in employer contributions and employee contributions. So I get to do 25%, 25K as the employer into the solo K, plus an employee contribution, which is 23,500 for 2025. That gives me a total of 48,500. The 25%, 25K plus the 23,500 for a total of 48,500 of contributions into the solo K for tax year 2025. Now I can decide, let's call those traditional. I want them to be traditional contributions, and I want a tax deduction on all of that. Now, if you're sitting right now in February, March of 2026, and you're like, ooh, I want to do the solo 401k. What can I do now? Or even the SEP IRA or the IRA? Well, you still have time. So let's walk through them. The IRA, you can do that until April 15th. Okay. But on April 16th, 17th, even if you extend your return, you can't put in 2025 contributions. So you've got until April 15th if you want to do traditional or Roth IRA contributions. SEP IRAs, we have until the tax return deadline plus extensions. So the tax return deadline for most self-employed people, if you're an S corporation or an LLC tax as a partnership or a C corp even, your tax return deadline is March 15th. Plus extensions, though, is up to September 15th. So you'd really have until September 15th, let's say you're an S corp owner, to actually set up and put money into your SEP IRA for 2025. Solo 401ks. This is why tax lawyers exist, because it's all freaking confusing and the rules are different here. Okay. Solo 401ks. Let's again say we're setting it up now in 2026, but we want to take the 2025 deduction. Well, that employee contribution part, that 23,500, has already passed. You would have had to have set that up by the end of the year and actually elected to make that and got that money in, and it would have needed to be reported on your W-2 by January 30th of 2026. So the employee contribution is out the window. We're not putting that in if you're an S-corp owner here in the example. But the employer contribution will still work. So I can throw in employer contributions. So that 25% of 100K in the example, that 25K could still go into the solo K now. But think about this too. We're in 2026, so I can make 2026 contributions now as well. So, which plans are available depends on your situation. Are you trying to do a IRA, SEP IRA, or solo 401k? I think the solo 401k gives you the biggest bang for your buck. We set up a lot of them at Directed IRA, and we can still get them set up right now in order for you to take advantage of 2025 contributions. Now, a little side note here, and this is probably a little, TMI, but TMI in this terms of tax stuff is if you're a sole prop, all right, you have until April 15th to set up your solo 401k, and you can still make employee and employer contributions until then, but you can't make additional contributions after the extension of that from April 15th. Okay. The rules start getting a little wonky here. So what I would just say is book a call with our team at Directed IRA. We have a team that works on solo Ks regularly and is familiar with the rules on what your situation is if you're trying to get that set up to make 2025 contributions. If you're like, I'm just trying to do this for 2026, Matt, it's not that complicated. It's where we're trying to go back into the prior year to make contributions where the rules start getting dicey between sole props versus S corporations versus tax return deadline versus extension deadline. Okay. So it just gets a little more murky. All right. But the good news is you've got options and there's still ways you can get some money in. All right. Now, I want to hit your questions. So thank you for those in the chat, though, asking questions. My team's in there engaging. I've tried to do the chat on my laptop live, and it was a disaster on Wealth Office Hours episode 2. If you were on, you probably witnessed that. I wasn't good. And I just can't multitask. So I've got some questions in advance. The team's in there engaging. And also, any of those questions that you're asking, a lot of them we pull from prior Wealth Office Hours Live for the next one. So we'll be answering your questions. I want to hit some that came in advance because a lot of these questions are exactly on topic to what people are thinking about right now before they're filing their business tax return. This one is from Kiki and Jeffrey Pearl. And they asked, if you buy a truck through your business and you drive to look at real estate to purchase, is that business mileage? Okay, and what they're asking there is, can I write off that mileage? I have a truck. I bought it to go look at real estate, and maybe I drove 1,000 miles looking at real estate. Or maybe I want to take bonus depreciation even on it and expense the whole value of the purchase price of the truck. Can I do that? Yes, but you must be in the business of real estate. If you haven't bought any real estate or you're not in the business of real estate already, you don't have a rental property on your books, you're not a contractor working on property, or if you're flipping a property or something that shows you're in the business of real estate on your tax return, you're not taking this deduction. You must be in business. All right. And if you're just looking at property to maybe invest in, that's not deductible. Now, if you later buy property, let's say you were doing that in 2025 and you actually buy property in 2026, well, that mileage in 2025 can carry forward and you can still use that expense essentially, because you were incurring that mileage, let's say in this example. But otherwise, you must actually have real estate business, whether you own property, there's rentals on your tax return, or some other real estate business showing up that has some business income. But great question. Next question is from Vital Win 1310. They asked, on the 100% bonus depreciation, would a vehicle have to be brand new and would it have to be a certain type of vehicle? In the past, it had to be a truck or SUV or minimum size or bigger. Okay. For bonus depreciation, there is a weight requirement. So this is typically the truck, the SUV or van. They will meet those weight requirements. We can put those in the chat, those amounts under the bill. I don't exactly remember the weight requirement. So if you're trying to take the bonus depreciation, Now, you can still take other write-offs on the vehicle, but for some of this bonus depreciation, there are going to be the weight requirements to do the 100% write-off. Now, that doesn't mean you can't still do mileage. You've got a car you're driving for business. That doesn't mean you can't take depreciation on it and take it over time. Maybe it's over a 5 or 7 year window. That's still fine. It's just if you want the bonus, it's got to. It typically is going to have to meet those weight requirements, and we'll drop those. My team will drop those the vehicle amount in the chat, the weight amount. Okay, from Real John Snow. Real John Snow asked, if 100% bonus depreciation is back, how do I decide whether to use it all this year versus spreading depreciation out over future years? Okay, this is a great question, because let's say that you're in a low income year this year, but you bought a new vehicle or other equipment in your business. You might not want to take bonus depreciation this year. Maybe you end up being in a 25% tax bracket, and you're usually in the max 37% federal tax bracket. So if you had a rough year or a lot of other write-offs you could take in 2025, you may not want to take bonus depreciation, because the value of that write-off and putting it all into this year is going to be less than you spreading it out at the 37% rate, which is a higher rate over time. So now, if you're in the max rate already at your highest level of income at 37% federal, then it doesn't matter. But the only time I would say you may not want to take it, even if you are eligible, is if you had a lower income year than you typically will have. Because in general, we all, income and tax rates being the same, we'd rather save taxes now than later. It's more valuable to us to keep more money in our pocket now than later. So I'd otherwise say take the deduction if it's available to you now. All right, the question in from Amy Styles 12345 says, if I elect S-corp status to save on self-employment tax, a strategy we love S corporations. It's a way to save on self-employment tax, as Amy mentions here. But her question is, how does that affect my 20% QBI deduction? It's a good question. So let's say you're a sole proprietor now, Amy, what happens is you get a 20% QBI deduction on your business income, right? But when you go to S corporation status, you get a 20% deduction on your business income, but not on the W-2. So when you're an S-corp owner and you're working in the business, you have to take what's called a reasonable salary and take a W-2. Then you also will push out income as profit, or that's when it's going to come through on the K-1. That profit or K-1 is where you get to take the QBI. So let's say you made, I don't know, 200 grand for the year, okay? And you said, all right, I'm going to pay myself 50,000. I don't know. Let's say here, let me say I'm going to pay myself 70 grand as a W-2, and 130 is going to come through on profit. Well, in that instance, you only get 20% QBI on the profit, on the pass-through coming through on the QBI. So there is a little balancing out there on the QBI versus the savings on the self-employment tax. But what we see, as your income goes up over time, you're better off doing the S-corp election, and your salary does not go up commensurately. Like eventually you might be making, $1 million, but your salary is only 150, and so it's not like these percentages are going to, work out where you're not going to want to do the self-employment tax and not do the S-corp because of the 20% QBI deduction, what you'll give up. So in other words, as you have more income, you're going to have more profit and K-1 income coming through that you'll get the 20% QBI on. So take Joe Biden, for example, right? His tax returns were disclosed. He had an S corporation. I mean, he was taking like $150,000 salary and was having like $8 million coming through in profit, all right, which would be eligible for QBI. All right, great question though, because you do want to balance that. That's a good point. And the QBI is on the K-1 income on the S-corp. All right, the question came in from Phoenix Flyer. It says, if I file an extension, does this give me more time to implement tax strategies, or is it just more time to file paperwork? It is more time to file paperwork. Sorry, Phoenix Flyer. The amount of tax that you owe by, let's say on your individual return by April 15th, must be paid by April 15th. So even if you make an extension of your return until October 15th, I'm talking about your personal return here, which is where taxes due. Even if I extend till October 15th, you still need to estimate what you owe by April 15th and send that into the IRS. If you don't send anything to the IRS on April 15th and you then just pay all your tax on October 15th when you finalize your return and you send it in on the deadline, you're going to get some penalty. It's not massive, but there will be penalty that you're going to be paying on that. So the extension of your tax return is not an extension to pay. It's simply an extension to file. Now, one other thing, if you're like, man, I need to learn way more about tax strategy, maybe you're watching this right now and you're overwhelmed by some of the stuff that I've said, there's too many things going on. It's okay. Extend your return. If you got too much stuff going on right now between your business return deadline of March 15th, or maybe your individual return or your sole prop return on April 15th, file an extension. Okay. It is okay to file an extension. Most business owners file extensions. And in fact, your chances for an audit when you file an extension go down. The IRS audits you less and audits at a lower percentage for people who file an extension. So that's at least one perk and one reason to do it. But a better one is making sure you're ready, you got your stuff together, and you've taken advantage of every deduction possible to you. All right, let's keep rolling with the questions here. We had another question in from VPN Nguyen 1. It says, how do you get around the kitty tax? Now, this is about the Trump accounts. I have a video and Wealth Office Hours Live. I have a number of stuff out there on Trump accounts. I love Trump accounts. Okay, you can put money in for your kid, no deduction, but that money you can put in every year, and it invests in the U.S. stock market, no taxes as it's growing. And once the kid reaches age 18, this effectively morphs into a traditional IRA. Now, at first, when I saw this about Trump accounts, I was like, that's not that cool. I didn't get a deduction to put the money in, and it just grew, and now it's effectively a traditional IRA. What's so great about it? What's great about it is you can convert that traditional IRA to a Roth IRA. Now, one of the questions that came up on some of my other videos, as I've talked to some other tax professionals as well, is does the kitty tax apply when let's say your kid now, you put money in their Trump account, all right? They got 100 grand in it now. They're 19 years old. And you're like, all right, this Trump account turned into a traditional IRA, but now we want to convert that traditional IRA to a Roth IRA. And I love that. That's kind of why I love Trump accounts in general, is because we can convert them to Roth IRAs. And when your kids are, in their late teens or their early 20s or late 20s, whatever, they're in their lower income earning years. So for them to convert to Roth, it's not that painful. They're in a 0 or 10 or 15% tax bracket. So let's get that converted at a young age when they're in the lowest tax bracket they'll ever be likely in their life. Now the money's going to grow and come out as Roth dollars later on. So that was kind of the strategy. Well, the question came up, does the kitty tax apply? The kitty tax is a tax that says, hey, if you are a child, an adult now, 18 or older, and you still rely on your parents for support, more than 50%, and if you're in college up to age 23, or it's still in school up to age 23, where you're claimed as a dependent on your parents' return, when you have unearned income, which a Roth conversion is unearned income, your kid pays tax at the parent's tax rate, not their own. All right. Did you catch that? That's not good. Okay. So let's say that your kid is 19 now and they rely on you primarily for support. They're still in school. You're claiming them as a dependent. Well, now when they do that Roth conversion, it's at your tax rate, not their tax rate. So a couple things to think about as you're doing this strategy. One, wait till they're 24. Kitty tax is only up till age 23. Wait till they're 24. That way you're outside of it. And they're still going to be in a lower income earning power than they're likely going to be for the rest of their life. So could be an opportunity to convert there. Second option, don't have your kids be dependents on you. Maybe they are already working. Maybe they're doing school part-time. Maybe they don't rely on you for the majority of their support. Don't claim them as a dependent. Frankly, if you're a high income earner, claiming your kids as a dependent doesn't help you with taxes anymore. You don't get the tax deduction benefits from claiming as a dependent. So you'd only claim them if you had to. So if they have their own independence, and maybe this happens when they're 20 or I don't know what it is, but when that happens, that's the year that they want to start converting and doing this conversion to from the Trump account that turned into traditional IRA to a Roth IRA. So that was a great question. I put an answer, by the way, on one of my prior YouTubes on it with some details on it. That was a great question from VPN Nguyen. Okay, I got to get rolling here and get through these. Sorry, I used to bill clients by the hour, so I can take a while explaining something. It can go for a while. All right, GMA 1918 asks, curious if it was wiser to open and fund a Trump account or an education account. If one only had $5,000 a year to dedicate to their child, is college debt or retirement more important? Good question. I kind of, when I think of college debt and your kids going to college, my strategy for my kids was get good grades. And it's my oldest two, get good grades, get a full ride scholarship, and I'll help you with your expenses. But nobody's paying tuition because you got a full ride scholarship. That was my two oldest daughters. They want full ride academic scholarships. Okay. Now, as a parent, kind of proud of that, right? That's good parenting. And also it's good for them in their financial situation because they didn't have to come out with debt. Okay. Now, maybe you have a child going to a trade school or other school or something like that. And the cost of that is much less. Maybe they're going to community college. That's my other daughter, right? The cost is just not that much. So they're not going to have much college debt. So I think that's probably the wise way to attack your kids in education. And we're going to do some other videos, and I'll probably do a Wealth Office Hours Live just on like planning for college and your kids' education expenses. But what I'm trying to get at here, it's not either or. It's not like if I only got $5,000, do I put it into a Trump account or a college education savings account? One thing I would think about for your situation is this money I'm going to put aside, and let's just say it's $5,000 a year. What do I want for that child? Are they old enough? Do I know that they're going to go to college even? Not every kid does, or it's not right for every kid. So a college savings account can sometimes not be that great. I will say if you're using a 529, the rate of returns on those are not great. So the compounding and growth of it isn't good. The nice thing about Trump accounts is these are going to kind of be in like US equity funds like the S&P 500 and stuff like that. So, excuse me, even though you can't self-direct these Trump accounts into like real estate or crypto or private companies or all that stuff we do as self-directed IRAs at directed IRA, even though you can't do it with a Trump account, I can at least do it in like the US stock market that's gotten a decent return. But the 529s have kind of got a bad reputation of having terrible investment returns. So the value of that compounding and growth, whether you're using that money to come out for college or using it to help build wealth for your kid in the future, is not great in a 529. So for me, my approach was do Roth IRAs for my kids because Trump accounts weren't around and my kids worked in my business. So that's what I did. What I would probably say is I would do a Trump account first for your kids. One thing is when you put the money in the Trump account, the contribution amount they call your basis, you can pull that out for whatever you want. It's not taxable. So, and there's a percentage there on how they calculate that for distributions. But that's one thing on the Trump accounts where you could maybe get some access to that money. But I don't know. I'm not against 529s or even Coverdell education accounts. You can put $2,000 a year into a Coverdell. I'm just more for college. Find other ways, motivate your kids in other ways, other ways to help take care of them. Let that Trump account or that Roth IRA for you business owners be long-term wealth building for your kids. It teaches them how to invest for the long haul, not just a temporary saving strategy to then get thrown at college. And then sure, you got out of college with no debt. And I get that approach, but I'm not saying that's wrong. I'm just saying my position, I like the Roth or the Trump account now. Okay. Do I need to create a separate LLC to protect my brokerage account or retirement account? This was from Dr. Elam. No, I wouldn't use an LLC to protect a brokerage account. Now, we use IRA LLCs for where a client's using a self-directed IRA to own like a rental property. Okay. So like my retirement account's invested into rental real estate or other private assets. So I have my IRA own an LLC 100%. And by the way, we've got videos on the IRA LLC. We'll drop a link to on the checkbook IRA and IRA LLCs in the chat. And that LLC owns the rental property. The reason I'm using the LLC there is if tenant slips and falls, they're forced to sue the LLC. The other reason is I get a bank account with the LLC. So my IRA invests its cash into the LLC. This is a self-directed IRA, by the way. We've got lots of videos on this. So if you're like, what the hell is he talking about? There's other content on this as a self-directed IRA strategy. I got the asset protection, but I also have a bank account for the LLC that I can control, and I'm manager of the LLC. I don't own the LLC, Matt Sorensen. My IRA owns the LLC, but I'm manager of the LLC, and it has a bank account, so I have a little more control in making investment decisions and sending money around as I'm making investments for my self-directed IRA using the LLC, or as I'm managing the investments. Okay, question came in from Everwheresamine. Everwheresamine. Sorry. I'm sure there's a way to say that, and I'm totally screwing it up. But question is, so I'm in my 60s, still working. Can I move some of my 401k to my IRA, or do I have to move it all at once I retire? I'd like to start making money and having it in my control and not the company's. All right, this is a common question. A lot of 401k plans are very restrictive. Your investment options are limited. Maybe it's some mutual funds or target date funds. It's on the mutual fund menu at the 401k provider that you're with. And so if you're in that situation, you may be like, I want other investment options, even if this is stocks or self-directing, whatever it may be. So yes, once you hit retirement age, which in some plans is 55 and in others it's 59 and a half, even if you're still working, you can move money out of the 401k, which can be all or a portion of the funds. This is called an in-service rollover. All right. So what I would look is do the in-service rollover, and you can move that money out to an IRA. Even if you're going to make the same investments, what I will say is IRAs have lower fees. Okay. So the average 401k total fees is 1.5%. You just don't see it because it's nickel and dimed everywhere. But let's say you have a $100,000 401k, there's actually $1,500 a year coming out of that in fees. So you might do better with an IRA, whether that's somewhere like a directed IRA where you're self-directing and it's a clear and straightforward annual fee, $495 a year, or whether you're at a brokerage IRA that's you don't pay for, but they effectively make money on the trades, but it's not money out of your pocket. So generally the IRA is going to have less fees and greater investment options. All right, 2 more questions here, and then we'll wrap it up. And thanks everyone for participating and being here live. I appreciate it. Thank you for the questions you're dropping in there. But let me get through 2 more questions here. Appreciate everybody hanging in. All right, this came in from Ramiro Sepulveda 2306. Says, if I'm already maxing out my 401k at my job and also maxing out my Roth IRA, can I still invest in an HSA or not? Yes. So, and I love this because you're doing all the things here. All right. These different buckets, 401k at work, hopefully you're getting a match out of that at work. You're using the Roth IRA, maybe you're high income and having to do the backdoor Roth IRA, and also dropping money in the HSA, assuming you have a high deductible plan, which, by the way, the HSA contribution deadline is April 15th as well. So as long as you had the qualifying high deductible plan in 2025, you can make the HSA contribution still sitting right now in February, March of 2026. You can still make that for 2025 and get the deduction. And I love the HSA. All right. The 401k is great, right? We're getting a deduction. The company's matching it, hopefully where you're at. You're getting the tax-free Roth dollars going. But the HSA, I'm getting a deduction to put it in. I can invest that money and grow it, whether it's in stock market or a brokerage HSA, or it's self-directed into crypto or a private company or real estate, whatever you're into. But I'm investing it and growing it. And then it comes out entirely tax-free for medical. All right. So the HSA is cool because it's one of those, that triple tax benefit, tax deduction on the way in, no taxes, I'm investing and growing it, and then tax-free on the way out for medical. We all have medical, and if you don't yet, you're going to have it once you're old, so this will come in handy. All right, last question here was from Frank G. 1963, says, if I'm transferring my own interest in an LLC that owns a rental to another LLC, like a Wyoming holding LLC, through documentation of the operating agreement, and by the way, you need to do what's called a membership transfer, does this qualify as a reporting requirement for FinCEN for the real estate report? And this is referencing last week's Open Office Hours Live, where I talked about this new FinCEN requirement. There is a new law in effect on March 1st, 2026 that says, for you real estate investors, if you transfer property from your personal name to your LLC, or you use an LLC and you buy property for cash, or you use an LLC and you do a creative finance deal where there's no bank or mortgage lender involved, you have to file a report to FinCEN saying what the property is and who owns this LLC. This is part of money laundering stuff the federal government's trying to target, and they think LLCs are being used inappropriately to hide and disguise money laundering. So this requirement goes into effect March 1st. It's right around the corner, 2026. Now, there are triggers of when you have to file this. Now, we do this in my law firm, KQS Lawyers. We set up thousands of LLCs a year for clients. We're doing lots of them for real estate investors. And the whole point of having an LLC is asset protection. Well, I have to deed the property into the LLC to get the asset protection. We will take care of this report for you, by the way. We're charging just an extra $50 more for the deed. We'll file this report to FinCEN for you so you're staying in compliance. It's private. It's not publicly available or searchable. So there is so that can be taken care of. Now, I don't like it. It sucks. It's one more thing on your list to do. The government's making you. I get it. But I just want to say we've got an easy workaround here to make sure it's taken care of so it's not on your plate. Now, giving context for Frank's question here. He said, his question was, what if I'm just changing the ownership of the LLC? I'm not moving title to the property around. I have an LLC that owns the property, but I have another LLC that owns the LLC. So I've got me, I've got a Wyoming LLC, I've got a property LLC, let's say maybe in Texas, that owns a Texas rental, okay? We've got 4 layers there. We've got an individual, we've got a holding company in the middle in Wyoming, we've got a property LLC in the state where the property is located, and then you've got the property, all right? If he moves the ownership here in this layer of who owns this LLC in Texas in my example, does he need to file anything to FinCEN? No. The reason being is the underlying ownership remained the same. It's still you. Either way, whether it's you, your trust, or this holding company in the middle, the beneficial reporting and what would have been on this report would just identify you anyways. So no need to update anything or nothing that triggers any reporting requirement with FinCEN. Okay. That is all of the questions that we had for today. Thank you, everybody, for tuning in to Wealth Office Hours Live. A couple of announcements I want to make, though. First, make sure you're subscribed to the channel here. Turn on notifications so you're hearing about when we're coming live. I also have a newsletter you can get at mattsorensen.com. You'll get updates on things going on. I have my self-directed IRA Summit this April 17th. It'll be 100% virtual. This is a full day where we go over how you can take control of your retirement by investing it into real estate, private companies, crypto, assets you may know and believe in better than the stock market. It's up to you. But we have a full day on teaching you the rules and how that works, where you can be captain of your own ship and building a retirement and something you're looking forward to, not a retirement you're actually dreading. So I'd love to see you there. Go over to sdrasummit.com. That's where you can learn more about the Self-Directed IRA Summit. Again, we'll be back here every Thursday live, 4 p.m. Pacific time. We'll see you next week.